Have you ever watched a massive market swing and just felt your stomach drop? Yeah, we've all been there. Today we're going to break down exactly how you can turn that market chaos into a structured advantage. It's all about keeping you calm, cool, and most importantly, keeping your portfolio growing.
Okay, let's dive right in with a fundamental question. Would you rather drive yourself crazy trying to predict the market's next move, or build a resilient system that actually benefits from the ups and the downs? Look, for most of us, gazing into a crystal ball is exhausting, right? We need a solid framework that works literally no matter what the market throws our way.
And honestly, it is so easy to see why a system like that is absolutely crucial. Think about the environment we're operating in every single day. You open your phone and the headlines are screaming that the market's hit an all-time high. Then, the very next morning, you get slapped with looming recession fears or some terrifying new inflation data. The market crashes, it recovers. It's a total psychological roller coaster. And frankly, it's enough to make anyone just freeze up and miss out on long-term growth because they're simply too afraid to make the wrong move. But there's a highly logical solution to this very emotional problem, and it's called dollar cost averaging, or DCA. Now, if you're tuning in from outside the US, you might know this as a systematic investment plan, or SIP. The core idea here is incredibly straightforward. You invest a fixed dollar amount at regular intervals, maybe that's weekly, monthly, or quarterly, and you completely ignore the current price. It is the ultimate set-it-and-forget-it method. And this brilliantly illustrates exactly how the math actually works in your favor. Imagine you're investing $500 a month for 3 months. Month 1, the price is $100, so your $500 buys you 5 shares. Month 2, the market dips and the price drops to $80. Now that same $500 grabs you 6.25 shares. By month 3, let's say the price hits $60, your $500 is now scooping up 8.3 shares. Just by committing to a fixed amount, you're automatically buying more shares when they're on sale, dragging your average cost down over time. Oh, and fun fact, in India, they call this rupee cost averaging, but the underlying math, absolutely identical. Now, it's totally fair to ask, what if you happen to have a bunch of cash just sitting on the sidelines right now? Say you just got a $10,000 bonus. Should you spread it out using dollar cost averaging, or should you just dump the whole lump sum into the market all at once? Let's compare these two, because this is where the theory and the reality of investing start to collide in a really fascinating way. Now, what's really interesting here is what the hard data tells us. There's a landmark Vanguard study that found lump sum investing actually outperformed a 12-month dollar cost averaging strategy in about 67% of rolling periods across US markets. So, mathematically speaking, dropping all your money in at once wins 2/3 of the time. So you might be thinking, if the math clearly favors a lump sum, why on earth are we dedicating this explainer to dollar cost averaging? Well, because of this simple truth. Most investors are not robots with ice water in their veins. First off, the vast majority of people just don't have large piles of cash sitting around. Their money comes in monthly from a paycheck. So DCA isn't just a choice, it's really their only practical option. But secondly, human psychology is a massive factor here. The absolute terror of investing $10,000 right before a major crash is very real. And that fear usually leads people to panic and sell at the exact wrong time, usually right when they should be buying. And let me tell you, panicking has catastrophic consequences for your wealth. Psychological research shows us something pretty astonishing. If you try to time the market, get scared, and end up missing just the 10 best days in the stock market over a 30-year period, it literally cuts your long-term returns in half. Think about that. Dollar cost averaging keeps you in the game. It completely removes the emotion from your decision-making process, making absolutely sure you do not miss those critical high-return days. Let's move to how we actually build this into an actionable professional strategy. Let's say you do have that $10,000 bankroll and you want a tactical approach. Many US advisors use what's called the 5% from 12-month highs system. Here's how it works. Step 1, you invest your money into a low-cost S&P 500 ETF, something like SPY or VOO. Step 2, you track the market. If the S&P 500 is within 5% of its 12-month high, you just continue your regular investments into equities. But step 3, if the market drops more than 5% from that high, you take your remaining contributions and shift them into US government bonds until the market recovers. To put that into perspective, let's look at the historical results of that exact system. When tracked all the way from 1972 down to 2019, this specific strategy delivered an average annual return of 11.7%. But here is the most important part for your peace of mind. It cut the maximum drawdown in half. So instead of your portfolio dropping by a terrifying negative 51% during the absolute worst times, the drop was capped at just negative 23%. This system lets you keep buying the dip safely without having to perfectly guess the absolute bottom of a crash. Ultimately, becoming a truly smart investor requires a massive shift in mindset. You kind of have to think of investing just like going to the gym. If you miss one day of working out, it's not going to ruin your health. But if you stop going entirely, you lose all your progress. Investing operates on the exact same logic. It is entirely about routine, discipline, and consistently showing up, not about predicting what the scale or the stock market is going to do tomorrow. So the crucial point is this. You have to ignore the noise. The goal here isn't to get rich quick. By using dollar cost averaging, you are actively embracing uncertainty. You're basically accepting that you cannot predict the future. So you simply buy the dips, weather the inevitable storms, and let compounding work its quiet magic over the years. Because whether you're investing $10,000 or just $100 a month, time in the market is always going to beat timing the market. Which leaves us with one final, pretty important question for you to consider as we wrap up today's explainer. Are you going to keep stressing yourself out trying to guess the future? Or will you embrace uncertainty and build a disciplined system that wins anyway? The tools for long-term wealth creation are sitting right in front of you. It's time to set up your system, start today, and get rich slowly. Thanks for diving into this with me.